Well, hello, Maverick traders. It's market roundup time, the 23rd of June. Joe with you here, closing off the first month of summer. Well, I'm going to call it the first month of summer. We only got about a week left here, but let's take a look at what the markets did today. As we're expecting a pretty decent bounce off of an aggressive sell-off last week. I'm going to give you my 2 cents on this. It is my opinion. Take it for what it is. Take responsibility for the outcome. You guys understand the drill. Let's jump into a market analysis as the expectations of a pretty strong bounce have so far fizzled out. We still have another day. Let's get into it. Now, overall, the markets still are up, and they are off of the lows set on Friday of last week. Well, actually, Thursday of last week, because Friday we had a little bit of a relief. Then we had the holiday, and Tuesday, Wednesday, and Thursday have been promising so far. Not a lot of selling, but just not that much buying. We expected a +2 move, and we have yet to get it. You can see all of the indexes are higher. The NASDAQ, 1.62% is kind of what I would expect to see Monday, well, not Monday, the holiday, sorry, but Tuesday, Wednesday, and Thursday, and even into tomorrow. We might see that. Once again, the week's not done yet, but I would expect more than just shy of 1% on the S&P and just over 0.5% on the Dow. I would expect 2%, 3%. I was expecting 5 to 6% for the week, to tell you the truth, and so far we're just not really mustering it. A good sign is that oil has dropped again, 2.12%. I believe it's below 105 a barrel, 106, 105, somewhere down in there. But that's a good sign, and I think that's going to be a pretty good indicator of what's going to hurt us in the short term over the summer. I have to agree with what Rob was talking about on Sunday's Trading Room. If oil can stay down, I do believe this creates the ability for a soft landing, as there is some good stuff out there on the economic front, specifically employment. Employment is good. Unemployment is good. If we can keep this, we might be able to weather the storm. On the headlines, the Fed stance, we had a lot of Fed talk. In fact, we got some more tomorrow coming out. I believe San Francisco Head is coming out and is going to make their comments, so on and so forth. But Powell comes out and says their stance is unconditional, meaning the markets are reacting, but he believes that the economy is strong enough to absorb this, and which would be great. That shows confidence in the economy that he has, and we could stay on track to bring this inflation level down to the target that we want. However, he did hint of some sort of recession might be inevitable. Not saying that it's going to be years and years and years, but it might be something shorter term, hoping for some sort of a more towards a soft landing than the hard landing. But it really hasn't done much to the markets. I really wanted to see more of a move. That being said, we did have a pretty good close in, or I should say a good push into the close. So I'm thinking that's a little bit more optimistic. If we can get a big push on Friday, tomorrow, a good solid 1% on all of them, maybe 1.5%, 1.25%, that's kind of the bounce that I would expect in the markets. Now, it doesn't mean that it's totally bullish, and that was, quote unquote, the bottom. But we do need to see a little bit of relief when it happens. So we have yet to gain any traction. But the good news is, folks, these markets didn't just give up and fall apart, showing that there is a little bit of a breath to be taken. Advanced decline line, 35% decliners, 60% advancers. So not everybody really took participation in this move. And below and above the 50-day moving average still is definitely the bear side. A lot of the energy struggled today, but everything else just had a pretty standard oversold bounce. So where does that leave us on the charts? Well, take a look at the SPY here. What I wanted to see, and I'll get my pin out, is, and it's not done yet, we do have tomorrow. I want to see a retracement back up to this area. I really do. Really kind of was expecting a move up to this 390 area, but this 380 after this gap down, and this was that CPI reaction showing that inflation is still there and it's still a formidable foe. Look at the increase in the volume here. We might find this as resistance, and if that holds true, we might be in for a little bit more bearishness than we expect, which is fine. Our overall outlook for the month is -3, but I would like to see a little bit of relief up to the 390. That might not happen. That could create a little bit more panic. We could see a spike in the VIX, which means the next roll to the downside might be something like this. Versus if we got this 390 retracement, then we might see something, boy, it's kind of hard to compare. A little bit more like this. It's kind of, which one's better, folks? Well, they're both going down, but the second one over here is a lot more panic-induced. So a stair step down would be better, more absorbable, easier to trade. Doesn't mean that it can happen. So I'm still thinking, based on where we close, that we might even gap up tomorrow. But this area here now, this 380, is a pretty formidable resistance. Let's move over to the Qs. This did have the strongest bounce percentage-wise, and it is actually showing a little bit more of a measurable chart pattern. What I mean by that is it actually came back to actually hit resistance. So the SPY is below that. The diamonds are below that at their new levels, but the Qs are actually, hey, that's a pretty good, decent little rally. Maybe we can pop up and touch this 20-day moving average. We'll see, depending on how strong Friday is, and then we'll see where the next round of selling goes. And yes, folks, I'm going to say it, there will be definitely more and more rounds of selling, as these markets are definitely in bearish territory. We do have a Fed that's going to be aggressive. We do want to curb this and get ahead of it and so on and so forth. But yes, it's still gloomy. Companies aren't going to make the numbers they used to. The markets are actively selling off. Now, that's not a real indication of the economy. However, it will eventually spill into the economy, and that's what the Fed is talking about. The ability to absorb a recession or some sort of recession might rear its head before we come out of this. So let's see how light it is. Well, there's my 2 cents, and that's what I'm seeing in these charts. So here's the heat map. You can see everything did participate in the bounce. Semiconductors, not really insurance. Some banks didn't. Energy obviously didn't as well. So it was just an oversold bounce specific to a lot of companies, which did throw off a lot of my charts. However, there are some pretty decent trades up there I'm going to show you here in a second. But I just a little bit disappointed in the bounce this week so far. Hey, tomorrow we could have, like I say, 1.5%, 1.25% would be a really nice, good bounce to finish the week. But unfortunately for me, folks, it just creates opportunity for me to get bearish next week. Everything is below our indicators, the 20, the 50, the 20-50 slope, price action, so on and so forth. As you can see, I expect a 390 resistance. It's stalling out below 380. So that keeps me a little bit more pessimistic. I'm definitely going to stay -3 on my monthly outlook. I was at a +2 on Wednesday, trading room. Now, guys, I want you to cast your eyes, zoom in real quick just squint down to yesterday's candle. You can see the higher part of the shadow is where I was looking at it in the midweek update. And so I said that's a really good sign. I was expecting a gap and a move higher. And I was thinking we'd be closer to the 390 mark than below the 380 at this point. So I had a +2, and now I've moved that to a +1, thinking that, hey, at least we're not falling apart. So there's some sort of optimism there, but there's just not a lot of participation in the oversold movement. We do have some good bulls, CTLT, K-Web. You guys have been talking about the Chinese internet, and the Chinese companies have been doing really well. This one's held in there. I'm going to show you the chart. It's not ready to buy, but it's just showing some strength. Now, CTLT is a different story. Amgen is something I was actually looking at to roll over. I was thinking of shorting this stock literally today. But I do like it as a potential neutral trade if it could stay within a range. We'll get there in a second. And on the bear side, Disney's kind of falling apart. Steel's hurting paychecks. These are ones that came from our class yesterday. Deere and Caterpillar carryovers from last week, folks. I'm going to show you the charts because they were wonderful. They confirmed. They broke down. And if you're in them, you're doing great. And there might be more opportunity further on. Let's start with the bull. This is CTLT. I did like the confirmation of a bull pullback, that pivot point right here at $100 about 4 days ago last week. We had that inside day, the pregnant harami, right? The pregnant bull confirmed on Tuesday. I keep forgetting that we had that holiday. It's a short week, which also makes this a little bit difficult. If you missed it Tuesday, you could catch it yesterday or you caught it today. Target of about 115. It's looking really strong, really decent. Nice trade to the upside. K-Web, this is one of the Chinese stocks, and it's pretty interesting because they've been holding in there. I like the pattern on this. It might be a little bit early, so if you guys want to keep an eye on it, or if you're a little reluctant to jump into it just yet, you can wait for the ascending triangle pattern to break out of the 34 level. Although it did have a confirmation of a pretty ugly looking pivot point here, because this does gap up and down almost every day because it is a sponsored stock on the U.S. exchange because it is a Chinese company. So they will trade in China. When China closes, it opens up in U.S. When it closes, it opens up in China. So every single day, this thing price adjusts between markets. However, it's going in the right direction for you guys that are looking for something a little bit more bullish. No, AMGN actually, I believe, came to us, let me look at my notes, as a sideways to up trade. And I like it as a sideways to up trade. I still do. It was looking pretty bearish today. This was a really nice doji there. Sorry, guys, that's a box. I'd like to get a pin out of this. It was a really nice doji, but it looked like it turned higher. So I was expecting resistance up at the 20 and the 50-day moving average at the 245. But this is what I was focusing on, was this range. So this sideways is still pretty decent. This is a pretty sizable surge to the upside. This thing bounced off 230 very hard. So my idea was, okay, could I be bearish? And yeah, the idea is if this bounce is indeed going to be anemic and the market's just throwing the towel and we don't want to bounce, we're going to roll over, well, then I would love to play this down to 230. Now, 230 would be my target for obvious reasons. There's no way I want to fight that. When I hit that 230 mark and I see all that buying come in, I don't want to be anywhere near that with a bearish position. However, let me get rid of my chicken scratches here. You can see that we held in. And so the 245 might be a stall out point. It's right in the middle of this range. So if you guys want to play something sideways to down on this, I'm totally fine. Or just sideways. Anything above 230, anything below 255-ish, 257.50. I know that's a wide range. Or you could just intermittently just kind of shrink it down based on your time frame and outlook. But sideways looks pretty decent on this. Moving down to our bears, here is paychecks. I was really looking for this thing to roll over at 115 yesterday. I had the candle, then it was green, and then boom, today it pops up to 117 is where this closed. But I still believe in that 115 mark. So if the bears step back in and this bounce is indeed going to be super weak, or even if you just, maybe Friday goes a little higher, and then Monday we roll back over, a great entry for this to the bear side, I believe, is below that 115 mark. Big volume here. It was red because it ended up being lower than the previous day, but you can see the follow through was a little bit to the upside. 120 being my limit when it comes to the retracement, because then we get this nice little what could be a head and shoulders pattern, the start of which, or a continuation of a descending triangle. So a break below the 115 mark, folks, and I'm all over this as a bear. Let's take a look at a couple here that I liked. This was from my last roundup on Thursday, which we talked about here as agriculture breaking down, the increased price, the worries of supply demand. You guys heard all my soapbox talk. The confirmation was definitely on Thursday. Since then, here we are again. But here's another opportunity as it breaks below another support level. Doesn't mean it will. I would truly give this Friday, maybe even Monday and Tuesday to see if it's going to muster some sort of a bounce, especially after this fall. But it broke support, confirmed. It's breaking another support. The volume is in the right direction. It's looking really bad. So keep this on your watch list. If you're already in it from last Thursday, good work. You might be ringing the register because your target should be at that 180 mark, which it's playing with. We'll see what happens tomorrow. Or you could just kind of squeeze it and see how far it goes. The other one is the exact same thing. This is deer. We talked about this on Thursday as something that could potentially break. It was not on the watch list for the end of day, but this is what we're looking for, the confirmation of a break below that. Didn't confirm on Friday nor Tuesday or Wednesday, but it sure did today. It might feel like you're chasing it. However, you might not be if you want to play something credit side or sideways to down. But understand the caterpillar and deer are the exact same thing. Play one, not both. This one looks like it's about to start to fall with a volume. Look at the volume that it had today. Well, that is very impressive, but we'll see what Friday brings. As we did close, the markets all had a pretty good run into the close, so we'll see if there's a little bit of optimism going into Friday. So it's pretty tough. Shortened week. The markets were closed Monday. I expected a +2 bounce. I was behind it all the way, even yesterday, thinking, oh, we're going to get that surge. We haven't got it yet. Doesn't mean we can't get it tomorrow. But the markets haven't fallen apart. They're holding in there. The Fed comes out. They're going to stay aggressive. They understand where things are. It's a little bit more ominous than I expected it to be. But once again, there's no real reason for traders to put money back to work. We've seen what's happened with the cryptos. They're still struggling. It's one of those things where I do believe the majority of investors out there are starting to realize that the heyday's gone and that fear of missing out might not be missing out. It might be just ridiculous trying to get back into stocks just yet. Doesn't mean the markets are doomed, but we'll see. So though we're moving off of last week's lows, but the bounce isn't very strong so far. We'll see what happens on Friday. Inflation remains the focus. I didn't change economics here. Inflation definitely remains the focus for the Fed and investors. We're seeing slowing in almost everything but employment. I truly believe, folks, what's keeping us going is the unemployment number and the employment number. Everybody's got a job. Everybody's happy. Everybody who wants one anyways, and they're happy. We might see the employers start to tighten, and that's fine as long as people can keep their jobs, meaning less jobs offered. The jobs that we're seeing are in the wrong industries. It's going to be in the expansion and growth, manufacturing, shipping, production, so on and so forth. That we do not want to contract. Restaurants, services, so on and so forth. We know those are going to contract, but those are the jobs that haven't been filled. So we're in this little flux of a neutral area to where we can give a little. But once we start to see retraction in, okay, we're shutting down this plant, we're shutting down manufacturing, we're laying off production workers, that's going to hurt. That's really going to spill off. So let's see how long we can sit there. And maybe we can, I don't know, absorb most of this. So earnings reports, there's not out there. FedEx is out. They beat and they projected. They're up about 7%, just below 7%. We got Carnival Cruises. I think that's tomorrow, and then past that, we got like Nike and some stuff next week. But I don't think that's going to be, they're going to be specific to the stock. I don't think it's going to have an impact on the overall indexes themselves. So keep an eye on those if you're looking to trade them. But past that, folks, that's all I got. Stay safe out there, and let's see what happens as we end the week and go into the next. Thanks for joining me. We'll talk to you next time. See you later, folks.